Welcome to today's quick, simple video, fellow stock traders. So with the recent popularity of meme stocks such as AMC and Gamestop and so forth, I've come to the realization that there is a lot more retail traders flooding the market right now. And I know that a lot of retail traders don't have a whole lot of capital to invest, at least when they're first starting out. So you're probably starting out with a small amount of money. And to make your money go farther, or at least seem to feel like it's going farther, you're probably going to tend to move towards penny stocks when you're trying to, make a buck or get rich, however you want to word it. So knowing that a lot of you are going to be getting into the penny stock territory and trading penny stocks, there's something that you're all going to end up probably getting hurt by, but if not that, you're going to see a lot of it, and that is stock offerings. And I just want to briefly explain to you in a very rudimentary way what exactly a stock offering does. So if you're invested in a stock and they do an offering, basically what a offering is it is a company issuing more shares. And the idea behind selling more shares into the market is that it increases their capital. It gives them a way of making money. See, the stock market is a capital market, and the reason why stocks go to the capital markets in the first place and do like an IPO and first list. IPO, guys, initial public offering. This is how all companies start out. They offer their shares to the public, so it's no longer private. It's no longer just for private investors. Now anybody like me and you can get in on that company's stock and own a portion of that company's value. But when it comes to the penny stock world, a lot of what you're going to trade, these companies don't really have a whole lot of revenue, or they have a lot of debt and they're bleeding money and basically don't have enough cash flow or profit to keep the business going without finding an alternate way of bringing more money into the business. Hence, being on a capital market, they have the ability to raise capital by selling even more shares into the market than they did when they originally IPO'd. So this right here represents the company. That is their value. And just to not get too technical and get too involved in all the logistics of a public offering, let's just keep this very simple, and let's say this never changes. This is the company's value. This company, or this amount does not change. So this company's value for this is $1, and that could be $1 million, $10 million, $1 billion, whatever you want to call it. And let's say when the company first listed, they sold 10 shares into the open market. So there's 10 shares sitting out there for people like me and you to trade back and forth, for institutional investors to buy and hold, or for them to sell them to us. So this company's value is $1, and they have 10 shares available to trade. So that makes every individual share basically worth 10% of the company. But let's say this company run up on hard times. They don't have enough money coming in or enough profit to be able to continue operating. They once again enlisted on the stock market so they could raise future capital if needs be. And right now they need to because they're not making enough money. So what this company is going to do is they're going to sell more shares. Now, once again, an offering in itself does not change company value. They're still the same company worth the same amount. What this affects is you. So obviously I can't just take 10 more dimes, 10 more 10%, and stick them into this pot, because then you're going to have 200%, you're going to have $2. And obviously this company is not worth $2, it's worth $1. So what happens is your shares get diluted. So the share that you have right now that's worth 10% of the company, let's say this company decided to double the amount of shares that they have out there. They're going to issue 10 more shares for a total of 20 shares on the market now. And you can see how beaten up these coins are, because that basically represents what just happened to your share value. Because your share value is no longer worth 10%, because they issued more shares for the same value that the company is. So what happened is you now only own 5% of the company. So if they were to double the amount of shares, which most stock offerings aren't that bad, but nonetheless, just so you have a good idea of what's going on here, you are now worth, they've doubled the amount of shares they have out there. The company's still worth the same. So the trickle down effect is everybody now only owns 5% of the company. In other words, if you want to have the same value that you had before, you have to purchase twice the amount of shares to equal the same amount that you already had in the first place. So you basically lost 50% of your value. I can explain this video in other ways if needs be. If that still didn't quite grab your attention, if I didn't do a good job explaining it, let me know in the comments down below and I'll be sure to post another video, maybe expressing it in a different way. Once again, this is not a full analysis of what goes on with offerings. There's all kinds of other things involved, underwriters and stuff, and warrants sometimes are attached to offerings. That's all different stuff. I just wanted to make it very basically clear that when a company does an offering, they're diluting your value.